Thank you for tuning in to this presentation on buying an independent insurance agency. We've broken the discussion into 3 parts. This is part 3, in which I will discuss the acquisition process. I will go through step by step and give you some tips along the way. I encourage you to review the other 2 presentations, the first of which discusses the agency M&A market, and the second discussed what an agency might be worth to you as a specific buyer. Some of the content between these 3 presentations will be overlapping by intent. As I stated in the first 2 parts, my name is Michael Mensch. I'm a managing partner with Agency Brokerage Consultants. As it relates to this topic, I'm a client manager, so I'm involved in the process all year long for P&C and benefits agency clients, generally up to about $6 million in revenue. I hope that you find this information useful in your ventures. There's a little information about our company. We are a merger and acquisition advisory firm focused exclusively on the insurance brokerage industry. Our clients are in the P&C and life and health business. They're also retail or wholesale, so we kind of cross all ranges. We have 3 services that we provide basically. First one being valuations of independent agencies. We probably do 3 of those a month across the country. The second is we represent owners in the sale of their insurance agency, so we help them prepare and market the business for sale and negotiate and get the transaction completed. And the third is we represent select number of buyers on a retained basis to go out and find agencies to acquire. This is generally buyers that have lots of financial resources, very experienced, looking for multiple acquisitions. But those are the 3 different services that we provide. I may be biased, but I believe our firm has more professional credentials than any other in the industry. All of our intermediaries are certified business intermediaries through the International Business Brokers Association. And all of our principals are also certified merger and acquisition master intermediaries, of which there's probably 150 in North America. Our team also includes certified valuation analysts, certified appraisers, and we carry any required licensings that is necessary to transact the sale of a business in the United States. So each state has different licensing rules on who can be involved in negotiating the sale of a business, and so we also are licensed accordingly. So just to recap, part 1 was an introduction to the agency M&A market. We discussed why people are buying independent agencies, different reasons. We discussed where to find opportunities. We discussed the challenges that are involved. It's a very competitive market. And I talked about some pointers on how you can be more successful. In part 2, we discussed what an agency is worth to you as a specific buyer. We went through understanding different earnings measurements. We talked about risk. We talked about transaction terms and price. And then we went into cash flow after debt service, understanding return on equity, return on invested capital, and different ways that you can structure a transaction to hedge your risk. So that is a quick summary of those 2 video presentations. Okay, here is a flow map of how the acquisition process usually goes. I broke it down into 6 stages. The first stage, there's the identification of an opportunity. We're going to get into these in more detail. I'm just going to cover the overview of the whole process. Step 2 is the initial disclosure of information and discussion between the seller and the buyer. Step 3 is when an offer is presented in the negotiations. Step 4 is the wonderful due diligence process. I'm going to go through that in detail. Step 5 I call the contract closing phase. That's where you go through and remove contingencies to closing, having to do with financing approvals, carrier approvals, things like that. And step 6 is the transition after the sale closes. So this is just a quick overview of what we're going to discuss. So we're going to skip over the first step, which is identifying an opportunity, and go right to the disclosure and discussion. We call this the you show me yours and I'll show you mine stage of the process. Confidentiality is very important to the owner of a business for obvious reasons. If there's breaches in confidentiality, it can harm the business in its relationships with carriers. It can harm the business relationships with clients and employees. and cause the owner considerable headache. So generally, the owner is going to be very concerned about confidentiality, and if there's an advisor involved, they're going to do some heavy screening to make sure that before they release any information, the buyer is qualified to purchase the business. So some of the things that you're going to need to talk about is your experience in the industry, maybe which carriers you have appointments with, what's your financial capabilities, how much money do you have for the purchase, if you're pre-qualified for any financing, and what is your intent, when you're looking at the business, what's your intent to in purchasing it? You're going to maintain the office? Are you looking at just buying a book of business? Most importantly, we're just trying to make sure that somebody's not fishing for information. So understand that if there's some screening up front, it's for a good cause. When you sign a confidentiality non-disclosure agreement, there's things you should understand. Obviously, the intent is so that you don't talk to people about the sale. There are some people you can talk to. Your professional advisors are one, so you can speak to your attorney, your accountant about it. Generally, they understand confidentiality. If you're a bigger organization, you can talk to some key employees on a need-to-know basis. Make sure that they understand that you signed a confidentiality agreement and you're held to that. And when it comes to who you cannot discuss it with, obviously you can't talk to the employees of the seller without their permission. You do not want to just go around telling all of your employees who you're talking to. Don't want to go and reach out to carrier reps and other vendors without having the seller's approval first, because that's breaching the confidentiality. So it's very important that you understand all these up front. This is one of the most important details from the owner's point of view, and we ask the buyers always respect confidentiality as they go through the process. Okay, so once you've signed and executed a confidentiality agreement, what are some things that you should request initially? Well, if you're working through an intermediary, then they should have all of this information ready for you in a nice format. We call it either a confidential business summary, you may hear it called a confidential information memorandum, a pitch book, things like that. But generally, if you're working through an intermediary, you should expect this stuff. If not, you can ask the owner for a couple years of financials, a couple years breakdown in the book of business, understanding the carriers, the line of business, information about the customers, retention and loss history, some summary about the operations itself. Understand what the owner's expectation is, especially if it's not actively for sale, the business is not actively for sale. Ask the owner up front what they'd like for price and terms on the sale, why they're considering selling, what they plan on doing if they were to sell the business. And then you want to schedule a meeting with the owner. So one thing to know is that you want to get enough information so you have a good handle on the business and move forward with making an offer, a meeting with the owner. But it's not a stage where you want to jump right into due diligence and request a whole laundry list of different things, because usually that'll just scare them away and you're not going to hear back from the owner. But this kind of gives you an idea of some things you'll probably need to look at before moving forward with meeting the owner and making a formal offer. For most people, these items go without saying, so we're talking about when you actually meet with the owner. But however, I've been at enough meetings that I know that some of these things need to be repeated and said out loud. So we'll just run through these. Obviously, you want to dress and act accordingly. It's a business meeting. Focus on building rapport. It's going to take a lot of rapport to get through a transaction. You need to have good chemistry with the owner. Let them talk. Use sincere praise. Find commonality, things to talk about. I always say use Dale Carnegie's principle of be hearty in your praise and lavish in your approbation. You want to be genuine about the compliments that you give them. But remember, it's a chance for you to build rapport with the owner. Ask specific questions about the business. If they gave you information, try not to ask the same questions over and over again. Focus on specific questions based on the information you received. Understand what's motivating the owner. So are they retiring? Is there some other reason why they're selling? Tell them about your background, what your plan is, and what you need from them going forward. The most professional buyers that we deal with know how to work through the process, and they kind of lay that groundwork in the beginning when they're meeting with the owner as, here's what we need, here's where we're going to go from here, and we appreciate your cooperation, and kind of give them a timeline of how long it may take to get the whole process completed. And of course, you want to thank them for their time. Obviously, if the owner is meeting with you, there's some interest level, on their part. But as we discussed in the second presentation, there's a lot of competition for buying insurance agencies, so they always have other options. Either they can keep the business or they can talk to other buyers. So you will make sure that you do a good job of presenting yourself and trying to establish some rapport with the owner from the beginning. It's important that you try to understand what their motivation really is. I've created this table here based on the clients that we've worked with to kind of break down what was the underlying motivation for the sale. So obviously a big percentage has to do with people that are retiring. Over the last 4 or 5 years, we've seen a lot of people in situations where they had to sell their agency. They were in a financial bind. Maybe when the real estate market was doing well, they purchased buildings and over-leveraged themselves, but there may be a financial problem underneath. Sometimes there's a life change. They want to move. Maybe they're going through a divorce. Maybe they want to change careers. Sometimes they're burned out, tired of dealing with clients and employees, that sort of thing. Maybe there's a health issue involved, but it's important that you kind of ask the right questions to really understand what's the motivation for the sale. Okay, after the meeting and once you have enough information to move forward, then it's time to put together an offer for the business. I'm going to go through all the key parts to an offer. We're going to go through each one of these in a little more detail. But here I've outlined everything. First thing there is the form of the offer. You're going to present a term sheet, which is basically a simple offer, letter of intent, purchase contract. We'll go through those. What's the form of the purchase structure? What's the purchase price and terms of payment? What assets are included in the purchase? What are some contingencies to the agreement? What's the time frame that you need to get the transaction completed? How are you going to handle the employee matters? What representations and warranties? Those are things that'll be legal things that'll be in the offer. What are some covenants and then indemnifications? So we're going to go through all these, just outlining everything that's pretty standard in most purchase offers. So there's generally 3 forms of a purchase offer. The first is called a term sheet. It's usually a 1 or 2 page simple offer form. It'll outline the purchase price, maybe some terms, and just address your interest in the business. Second is called a letter of intent. It's generally a little bit longer, maybe 5 or more pages in length. It's going to outline other details of how you expect the owner to continue operating the business, how you're going to handle the employees, how you're going to handle different aspects, gives time frames for doing certain things. But the term sheet and letter of intent are both a non-binding form. Then you have a purchase contract, which is a binding agreement. Usually will have contingencies in it, but purchase contract could be anywhere from 10 to 40 pages, maybe longer in length. It's going to go through every single detail of the acquisition, lay out all the terms, all the covenants, and it'll be much more thorough. But it's a binding agreement. Usually if you're working with a lender, they typically don't want to get involved until you have a purchase contract that is agreed to, because that's when it becomes more of a formal transaction that's going to take place. Outside the form of the offer, you have the form of the purchase structure. There's 3 forms here. We're going to talk about them a little more, but there's an asset purchase, stock purchase, what's called a Section 338H10, which is kind of a hybrid between an asset and a stock purchase. And we're going to talk about the first 2 here a little bit more. So most agencies are purchased under an asset purchase agreement. You are acquiring specific assets. You are not acquiring the corporation. You're just acquiring the assets, the book of business, the goodwill, the employees, things like that. You're indemnified from liabilities unless you specifically assume them. So what you may assume might be certain contracts, certain accounts payable. The contracts and licensees are not assumable under an asset purchase. Generally, they're not assumable even under a stock purchase. I mean, most carrier contracts, you can't just assume them. You have to go through the process of getting approved. Same thing with leases and other things like that. When you do an asset purchase, you can amortize the intangible assets over 15 years. That means the purchase is going to be allocated to different asset classes. One of them will be intangible assets, such as goodwill. You'll be able to take that value, divide it by 15, and write that off on your taxes over so many years. The tangible assets you can usually depreciate over maybe 7 years or their useful life. So in doing an asset purchase, you get a stepped up tax basis. Through an asset purchase, the seller, if they're a C corporation, may be subject to a double tax. If they're not a C corporation, it's a flow-through entity, so in either a stock or asset purchase, they're generally going to be taxed on the personal level. When you do a stock purchase, you're acquiring the corporation. You're acquiring all assets and liabilities. And I say here, including contracts and licenses, but that's not always the case. A lot of contracts have stipulations that if more than a 50% or a majority share of the stock is sold, that you have to get the approval of the lessee or the lessor, whoever's on the other side of the contract. If you're doing a stock purchase, you assume the seller's depreciation and amortization schedule. That means you do not get a stepped-up tax basis. So you're assuming whatever write-offs that they have in place. You can't re-amortize the goodwill and those things. So as a buyer, sometimes you lose a tax advantage by doing a stock purchase. The benefit for the seller in a stock purchase is that if they are C Corp, sometimes they get around the double tax. So usually a stock purchase is beneficial to the owner if they're C corporation. It may also be beneficial if there are a lot of licensing. Say the agency is licensed in 50 different states or something like that. It may be a way to get around having to go and reapply for all those licenses. But those are generally the two structures that you can purchase an agency. Again, I talked about Section 338H10, which is a hybrid and kind of gives benefits to the seller and buyer. But there's only qualify for certain cases, very limited cases. So your offer is obviously going to lay out the purchase price. So what are the prices that you're offering? Maybe there's a formula involved, subject to due diligence. It's going to say the terms of the payment, how much money you're paying up front, terms of any future payments. Maybe there's going to be adjustments made. You'll hold money back in escrow to cover any unpaid debts. You may have an offset against the note for any cancellations or things like that. You may have clawbacks if there's an earn-out involved. Under the included assets, you're going to outline what tangible and intangible assets are included, if there's any working capital, accounts receivable included. So it's going to go through all these. You should have it include all of these different details in your offer. Purchase offers usually have contingencies in them. There's usually a due diligence contingency. There may be third-party approvals that are contingency to the closing. That could be if there's financing involved, if there's carriers involved, landlords, all those things. You have to get them on board with the sale and transfer of the business. You should have time frames outlined in your offer, how long you have this offer open for, so how long they have to accept it, how much time you need for due diligence. If it's a LOI or term sheet, there's usually a period of exclusive dealings, meaning it's a no-shop period where the owner's not going out and trying to take other offers. They're going to give you a certain period of time to run your due diligence and do all your homework on the business. There's a period of time that you're supposed to submit the purchase contract. So generally you want to be working on that as you're going through due diligence, having a purchase contract drafted. Again, that's if you're starting off with a letter of intent. You eventually have to present a purchase contract. Time frame for closing on the transaction, and then a time frame for how much time you'd like the owner to help you with a transition. The offer should address employment matters, how you're going to handle hiring the employees and producers, how certain liabilities are handled. So if there's vacation time accrued, who's going to be liable for that, benefits, those things. Terms of employment or consulting agreements with the owner. So if you're keeping the owner involved in the business, you're going to outline what their compensation will be, how long you want them around. Offer should have representations and warranties, as they're more along the lines for when an attorney puts together, but basically the owner is representing that certain things are true, that the tax returns are true, that all the information they provided to you is true and accurate, and there's going to be a certain time period that they're going to be liable if there's any fraud or misrepresentations. There's going to be covenants in there, how they're going to manage the business through closing, the non-competes, non-solicitation, all those things that are going to apply to the owner. And if you want an E&O tail coverage, how long you want that tail coverage to last for the owner. There's going to be a cost involved, so they need to do the research on that, probably weeks in advance of the closing. And then there's going to be identifying certain indemnifications. the owner's going to make to you and indemnifications you're going to make to them as well. Okay, so that ran through all the different parts of an offer. It's kind of a boring subject to go through, but if you're putting together an offer, you really need to understand all the details that need to go into it. Let's talk about some rules that you need to follow when negotiating. So rule number 1 I put up here is consider what the seller wants and what their motivation is. So understand why they are selling the business. What's their motivation? Is it retirement? Again, is it a financial concern? Is it a health concern? All these different things. It's important to understand what's going on in their head, because then you can kind of outline what's their priority. Is it getting more money up front? Is it being able to work for a certain number of years for you as an employee? Is it the total purchase price? They want to hit a certain number. So understand what their motivation is. Number 2, put everything in writing and have it drafted by an attorney and an M&A advisor. So what you do not want to do is submit an offer that lacks a lot of detail and then go through weeks or maybe months of due diligence and come back and change the terms and have new terms in there that the owner wasn't aware of, because all that's going to do is just burn out the owner, and they're going to be annoyed, and they're probably going to want to walk away from the deal if you haven't addressed certain things. So it's important that up front you address all these details that we just went through. Put it all in writing, have an attorney look it over, have an M&A advisor look it over, because there's certain things the attorney most likely will not understand regarding an insurance agency that someone who is involved in these kind of transactions on a regular basis can help build those into your offer and make sure that it's addressed properly. Number 3, know that time is of the essence. We say that time is a killer for all deals. The longer things drag out, the more worn out everybody becomes in the transaction, the higher the probability that the deal will fall apart. So you want to move forward diligently with reviewing information, getting the offer in front of the owner, getting through the due diligence, and just keep moving forward at all times. Number 4, have a discussion with your financier before agreeing to any modifications. So if you have to borrow money for the transaction and you present an offer that the lender would approve, the structure of the offer, if the owner makes changes in the negotiations, it's important that you go back to the lender or whoever's giving you the money for the transaction and you make sure that they are in agreement with those changes before you move forward and sign an offer with the owner. Number 5, be reasonably flexible. Again, you got to understand the owner's motivation. Some priorities may be important to them. Some priorities are going to be important to you. So usually if people are a little bit flexible, you can find a common ground and make things work. And number 6, use an intermediary. I don't say that just because that's what I do, but I say it because when one party is dealing directly with the other, there's a very high probability that emotions are going to evolve. And when emotions get involved in a business transaction, that usually leads to problems that can kill the deal. So it really helps to have somebody buffer in between you and the owner to kind of keep those emotions out. I've said this kind of jokingly before, but I've been yelled at many times. I'm not a person that causes people aggravation, but it becomes a stressful process on all people involved. So it's really important that you try and have somebody being an intermediary between you and the owner to keep that goodwill and keep that rapport intact through the process. Okay, let's talk about the due diligence process. Due diligence is a process where you verify the quality and condition of the business. You're verifying not only the information that was presented to you, but going through and getting a full, deeper understanding of how the business operates, any risks there are, any cash flow problems that might come up that you weren't aware of, things like that. There's commonly 3 phases of due diligence. First is the financial phase, there's an operational phase, and then a legal phase. We're going to go through all of these. The process of due diligence can vary from, I'd say a few days to maybe a month, maybe 2 months, depending on how complex the business is and how long it takes the owner to put together information. It could be overwhelming. You're going to be looking at tons and tons of data. If you are more of a sales-minded person and not an analytical person, it may be too much for you to try and undergo the due diligence without some assistance. And due diligence can easily make or break a deal. So we're going to go through a lot of different things you can ask for in due diligence. This is kind of a process that can be overwhelming. It can be stressful to the parties. But you want to make sure that you go into it and have a plan for how to execute through the due diligence as quickly as possible and get all the answers that you need as quickly as possible. When conducting financial due diligence, you want to verify the revenue. I'll give you different ways you can do that: tax returns, bank statements, carrier statements, 1099s. You can go through and look at their management system. You want to verify the expenses. Again, looking at tax returns, P&Ls, bank statements, looking at payroll registries, contracts that they have in place. So going through the financial aspect is verifying the revenue, verifying the expenses, making sure that you understand the cash flow of the business. You want to verify the liabilities. So you look at the owner's balance sheet, make sure that it's an accurate balance sheet, that there aren't unbooked liabilities. Look at the accounts receivable and payable. This can be very tricky. This can be complex if it's an agency bill business, because a lot of agencies run on a cash system where maybe there's unbooked receivables and payables. So you have to understand where that money is and what money's coming in has to go out. Because keep in mind, the payables can be significant amounts of money. You look at bank reconciliations. This is really where, if there's a lot of agency bill business, you're better off getting a due diligence person involved, someone that's an accountant that understands how to look at these things in more detail. So what to focus on: revenue and expenses for 3 years, year to date. Look at year to date for this year to date for the last year. Look at a trailing 12-month period. So you really want to understand what the historic trend looks like, what the current trend looks like, what the last 12 months look like. And under the revenue side, you look at, break it down by carrier, line of business, maybe client and producer, if they can produce that kind of detail. Look at it on a monthly basis. So really getting in and understanding the flow of revenue, the expenses on an annual and a monthly basis, and getting a real feel for how the business operates from a cash flow standpoint. What you really should try and do is create a cash flow budget. One mistake that some people make when purchasing an agency is they look at an annual financial statement and assume that the flow of revenue is consistent month to month. That's generally not true. We've seen agencies where 1/3 of the revenue comes in 1 month of the year. So you need to look at, on a month-by-month basis, what the revenue looks like from a historic point of view, what the expenses look like. Most expenses are going to be month by month, but some things are going to be on an annual basis. So you need to understand where those expenses are going to hit in which month of the year. And so you should really budget out a cash flow projection for yourself. If you have a lender involved, they're going to want to see that. If you have other financiers involved, investors involved, they're going to want to see that. So it takes a lot of time. Again, this is where a due diligence person can come in and help put this together for you. But don't assume that taking an annual financial statement and dividing by 12, that this month you're going to make $10,000 in profit, and the next month $10,000. It doesn't generally work that way. Aside from financial due diligence, there should be an operational due diligence. You're going to look at the ownership structure of the business, how many shareholders are involved. Understand the size of the office, the lease, the terms of the lease, what the workflow is like inside the office, how the sales processes work, what marketing the agency does. Have an organizational chart. Get an employee census, meaning the names of the employees, what they do, how long they've been with the agency, what their licensing is, how much they're paid on an annual basis, when they're paid, is it weekly, bi-weekly, quarterly, however they're paid. Get a summary of the office technology that's in place. Have a plan for how you're going to integrate that. If you have another agency, how you're going to integrate the two of them together. Get some historical reports. Look at production and loss history on some of the major carriers. Are there any E&O claims in the agency? Is there any litigation that's been brought up against the agency in the past? Has the agency bought any books of business over the last couple of years? Get any documents relating to that if there were. You will want to review all the contracts that the agency has in place. You don't have to go through the carrier contracts with a fine-tooth comb, but you need to understand what the compensation schedules, what the new and renewal commissions are going to be. You're going to probably have to get appointed with those carriers if you don't have them. Look over the employee and contractor agreements, understand how they're compensated, if there's any bonus plans in place, what the vacation time is for the employees. Look over the leases, for the office lease in particular, what's the term of the lease? Is there any escalation clauses for increasing the rent? And any other vendor agreements, just make sure you look over all the liabilities that you're going to likely assume. You can get copies of the owner's insurance policies, see what their coverage limits are. Get a list of the tangible assets that's going to be part of the purchase contract. So as you can understand, this is a very thorough process. You want to understand the financial aspects. You want to understand the operational aspects of the agency. If you're unfamiliar with this process, you should probably seek outside assistance in going through it, because if you're putting up hundreds of thousands, maybe millions of dollars on a purchase, you don't want to overlook anything important. It's usually what you don't look at that is the most troublesome in the when buying a business of any type. So go through and do a thorough due diligence. Last bullet point there says tailor your due diligence list to the actual deal. So if you're buying a small book of business, the due diligence list is not the same as if you're buying a multi-million-dollar agency. So don't just submit a formatted 10-page due diligence list if it's only a couple $100,000 transaction. Go through, if you get a formatted list, go through and strike out things that may not apply to that particular agency. Kind of tailor the list to the specific deal that you're looking at. If the agency doesn't deal in agency bill business, you can eliminate certain things. If it does, you need to add certain things. So tailor your due diligence list to the specific deal. And again, if you're unfamiliar with this process and maybe you're not a finance person or an accounting person, then you really need to get some assistance in going through that. We do a lot of due diligence work for our clients, and it's a very involved and time-consuming process. Some suggestions with your due diligence process. So up front, submit a list of what you need and go through it with the seller so that they understand what you need. Discuss any issues that come up or concerns that you have. Give them a chance to either explain something or provide additional information that explains it. While you're going through due diligence, proceed with your financing and the drafting of the purchase contract. Don't have a 3 or 4 week due diligence period. Wait till it's done, then start working on drafting the purchase agreement. Typically, if there's a letter of intent submitted, there's usually a couple weeks, and then you have to submit the purchase agreement, so that can be negotiated next. So everything should be kind of flowing in parallel as you're going through due diligence. Renegotiate if the due diligence results require it. So again, if any information was misrepresented from the beginning and it's significant, then you may need to restructure the transaction or renegotiate. Be willing to walk away if you're not comfortable with the resolution, but understand there's a sunken opportunity cost from walking away from a deal. Generally, we don't see that happening, but we do a lot of pre-due diligence for our seller clients that we work with. But you know, if you want to make sure that you're willing to walk away, but at the same time understand that opportunities for buying insurance agencies don't come up that often. So when you walk away, there's going to be a sunken opportunity cost involved with it. So after due diligence is completed, after you've negotiated the purchase agreement, which could happen before or after due diligence, usually attorneys are handling that, then there are typically some pre-closing contingencies that have to be completed. Those could include getting approval from a lender, getting approvals from some of the carriers involved, transferring leases, presenting employment agreements to the employees. That usually happens shortly before closing, drafting of final closing documents. So if your attorney is drafting the documents, they need to communicate with the seller's attorney. So there's usually a couple weeks to maybe a month's worth of time of other stuff after due diligence that has to be completed. Again, a lot of these things you kind of want to start before you finish due diligence, so that way you're not dragging the process out longer than need be. Once the closing has happened, money's transferred hands, then you got to work on transferring over the business. So there'll be things that the seller needs to sign. There's going to be a couple months probably where money is going to continue to flow into their bank accounts. So you need to just handle that properly, working with the owner, execute the new employment agreements, and then for whatever period of time you've negotiated, the seller's going to assist you with a transition. Maybe they'll stay on in some capacity and work for you. But the initial post-closing period may be a month. The intense part is usually the first month, and then it starts to dwindle off another month, and probably by the third month, you may not need the owner involved. Maybe you do, but there's a period of time after closing that there's a lot of work that has to be done. Okay, so I went through the whole process. It's probably a very boring presentation for the most part, but there's a lot of good information that's been relayed here. Really, the key to being successful in any acquisition is understanding what you're getting into, understanding the process from start to finish. The most successful buyers that we work with are the ones that know the process, understand what they have to do, when they have to do it, get it done quickly, work through everything, and the more deals that you do, the better you get at the whole process. But just wanted to run through all those things. That way, if this is your first time doing this, you've got a kind of a better base of knowledge to work from. Next, we talk a little bit about working with professional advisors. So involved in the transaction, you may have 4 different types of advisors. You may have a merger and acquisition advisor. That's what we do. Perhaps you've hired them to go out and find opportunities for you, agency owners that may want to sell. They facilitate the discussions. They manage the whole sale process. I'm going to talk a little bit more about what we do on the next slide. You want to have a business attorney that understands business sale contracts. They're going to assist with negotiating the offer and the terms. They're going to advise you on legal implications. You have an accountant maybe assist with due diligence, advise you on the tax implications. You may have a financier involved. They're going to advise you on how to structure the deal so that it passes their underwriting or passes their requirements, and obviously they're going to provide the capital for the transaction. So there's other parties that you're going to have to bring in to help you do this transaction. Make sure you're dealing with experienced advisors that are knowledgeable of your business, the industry, and the acquisition process. I say that particularly when it relates to attorneys and lenders. Make sure that they understand the process for acquiring an insurance agency and that they've done similar transactions. So I've talked before about what we do in our organization. We help people sell their agency. We help people buy agencies. We do a lot of agency valuations. So we're working with agency owners all year round, helping them prepare an exit strategy to sell their agency, bring their agency to market. We work with buyers who are looking to acquire agencies. We introduce them to different owners. So we originate opportunities for buyers. We facilitate the discussions I talked before about the value of having an intermediary. We perform a pre-due diligence for any of our clients. So before we bring an agency to market, we're kind of going through and scrubbing all the information, making sure we understand the business. We assist with drafting and negotiating offers. We've done this many more times than probably a lot of attorneys when it comes to insurance agency sale transactions. So we can add value when it comes time to prepare and draft the offer. There's certain terminology, certain covenants that we understand that maybe an attorney isn't familiar with. We assist with due diligence. We have a pretty thorough due diligence process that we put together. It's very organized. I'd say we probably shave off half of a buyer's time by the way we organize and prepare for due diligence. We assist with financing. When it comes to the sale of agencies under a couple $1 million in value, I'd say there's probably not too many other intermediary companies in the country that have the experience that we do when it comes to selling an insurance agency. We've been through the underwriting process with a lot of different lenders. We add credibility to the parties. I'm not saying that either you or the seller is not credible. What I'm saying is I like to compare it to when you're going to a dance as a kid and you see a pretty girl across the way. What's the best strategy? Is it for you to approach that pretty girl yourself, or is it for you to send over a friend to approach her? So by having us involved, I think we add credibility because you have a professional intermediary acting on your behalf, singing your praises, that sort of thing. We've reduced the stress and time involved. Again, as an intermediary, we kind of buffer the emotions involved. And most importantly, we make a deal happen. Not saying that every deal should happen, but when the deal is good for the parties involved And when everybody is generally in agreement with wanting to move forward and make the transaction happen, we work through, we help manage the process, we help manage the emotions, and keep everybody focused on getting the transaction to the closing table. So those are the different values that I think we bring as an organization when it comes to helping buyers. And I always like to say we are exceptionally good at what we do, and we work exceptionally hard for our clients. But don't take my word on it. Here's what some people have said about us. I'll give you a second to read this. First, the quote is from a buyer that purchased one of our clients' agencies. The second is a quote from an owner that sold to one of our buyer clients. And the third one is from a senior loan officer, actually from Oak Street Funding, one of the top lenders for insurance agencies. Here are a sampling of our buy-side transactions that we completed. These are within the last year or so. If you go to our website, you can see what we call a whole bunch of our tombstones of different completed transactions, but you'll see they're kind of all over the country. Originally, we were mostly focused in the Southeast. Now we're pretty much all over the country, working in about 10 different states, getting ready to close on sales in California, working on Ohio, Pennsylvania, a whole bunch of different states. So I thank you for your time. I hope you found this information useful. If you have not looked at parts 1 and 2 of this presentation, I would encourage you to do so. You can go to our website and see those. We also have other presentations on our website relating to developing an exit strategy, maximizing the value of your agency, and I'm sure we'll continue to add different topics in there. But if you would like PDF copies of these slides, please feel free to email me. If you have any questions, please feel free to give me a call. Thank you again. I wish you all the very best.